Red Cloud Financial Services is your preeminent source for mining industry opportunities. The team provides a unique, tailored marketing program dedicated to reaching the right people from its mining-focused global network, giving clients access to industry-leading events and conferences, retail and institutional marketing, plus an in-house growth-driven digital agency. Red Cloud Financial Services has access to some of the mining industry's most notable companies and CEOs.
Hello and welcome to this live core conversation brought to you by Red Cloud Financial. I'm Mark Bunting, the host of RCTV. We're going to be doing 5 of these over the next several weeks. We'll be talking to thought leaders. These conversations will be informative, they'll be educational, we're going to learn a lot, and we'll get some investing ideas as well. We are going to kick things off with Mike Alkin. He is the Chief Investment Officer and founder at Sachem Cove Partners. We'll bring in Mike in just a second, but just as a bit of a backgrounder, he's going to fill in more of the details here, but he has expertise in distressed assets. And so that's why he wound up looking at the uranium sector around 2015, because the price was at a trough, and he became interested. He did a real deep dive on uranium and nuclear. And around 2018, he determined that there was a structural supply deficit, which was a wildly different view from what nuclear industry bodies were saying about their supply forecasts. His views were initially dismissed, and he'll get into this as the industry came around to his way of thinking. Now, also, he's very connected, Mike is. He talks to fuel buyers all the time. He talks to fuel traders as well. He owns physical uranium. He owns uranium stocks. So having said that, as a table setter, let's bring in Mike Alkin here. Great to see you, sir. Thanks for joining us today.
Hey, Mark. How are you? Thanks for having me.
I'm very well. So let's pick up on this theme, and let's go back, and not so much the full trajectory. I'm sure you could go on for a long time, but just the genesis of looking at the sector, realizing there was this structural supply deficit. And then you had, I believe it was the World Nuclear Association, which actually invited you, after initially being dismissive of your views on supply, to speak at one of their events, and then the following year as well. So could you give us a bit of a backgrounder on all of that?
Sure. I've been in the investment business and the hedge fund industry for almost 30 years. My first several years, I was a short seller. I was looking for companies that were we thought would either miss earnings, or they were run by people of suspect character, or there was something unusual that we saw. And we do deep dive research. When you're short selling, your risk is unlimited to the upside. If you buy a stock, right, it can go to zero. If you're short a stock and you're wrong, it could go to infinity. So you try and do the deep dive research. You try and understand what the sell side, what consensus is. But then you do your own research, you do your own field work, and then you marry that with your own financial analysis and see if it squares with where consensus is. And you're taking a contrarian approach. And over the years, as I became an investor on the long side, buying stocks, it's the same methodology. You're looking, there are growth investors, momentum investors. I happen to be a deep value investor, a contrarian investor, looking for things and really steeped in the belief that investors, like most human beings, tend to have recency biases, that what is will be. And oftentimes that's not the case. And so in the case of uranium, it was a logical place for me to look back in 2015 and 2016, because the commodity had declined 90% or so from its peak. The equities had declined a similar amount. The number of companies declined a similar amount. So it was left for dead. It was abandoned. And so that's something that would actually naturally come on my radar screen. And then from there, it was just a matter of trying to understand supply and demand. And as you start to research the nuclear and the space and the uranium industry, it's very opaque. It's layer upon layer, and the nuclear fuel cycle, if you will, is many stages. It takes 18 to 24 months from the time it leaves a mine to the time it winds up in a reactor. It's not coal or natural gas where it's sent downstream and it goes. So, it was complicated. It took me a lot of time to learn both supply and demand, and then I modeled out supply and demand on my own and started looking at industry forecasts. And when I started looking at the industry forecasts, I thought I have to be wrong because they're materially off from where I am, and I'm relatively new to this, really new. As you mentioned, I started going to nuclear conferences and started talking to people, and it was really there where, when you study anything, you want to understand the market structure, the market incentives, the players in the market, understand the participants. And it was really there when my eyes really started to open up, because I realized I was looking at a cohort that had been in a really long bear market, had a strong recency bias, and people who commit capital, for the most part, investors, had left the building. They were gone. And so when I say the building, the sector. So it was an industry left to its own devices, just kind of mired in its own self-pity, and nuclear is going away and the price is down 90%. It will never return. And that's not what the numbers were suggesting. And even the forecasts were suggesting it would be mired in this terrible state for a long time. And as long as 11, 12% of global electricity, which nuclear is, was going to be there for a while, and I couldn't see why it wasn't, then I thought consensus was significantly wrong. And as you said, that was 2015, 16, 2017, doing more research, going to nuclear conferences, and then expressing the view through investment in 2018, started to do that, and took that view to the Nuclear Energy Institute, which is a large trade body in the United States that represents the industry. They do lobbying for them and all sorts of stuff. And, knocked on their door and said, "You don't know me, but I have a different view from consensus, what the industry forecasts are." And they said, "You're right, we don't know you. You probably know nothing, go away." But kept knocking on the door, and I found somebody very receptive there. And after a period of time of laying out through a presentation where we thought consensus was wrong and why fuel buyers would have to pay a lot more than the $19, $20 a pound that it was, they were gracious enough and said, "Come present to our annual meeting and talk to the fuel buyers." That was in 2018 in the fall, and I did that. And it was through that where I really saw an eye-opening experience for me, because, as I said, I'd been doing this now almost 30 years, but by then it was in mid-20s years, and doing field work throughout myriad industries from all sides: buyers, sellers, distributors, marketers, you name it, in any industry, and always met with curious people and people who were open to different views. And some people agree with you and some people disagree with you. That was not this. This I was met with a wall by nuclear fuel buyers. And any market participant told me, "You have no idea what you're talking about. Prices will stay this low forever, and you're an outsider, and basically get lost." And I started quizzing them and chatting with them, and through a conversation at a bar, at a meal, and I realized that, wow, these are really bright people. They're nuclear engineers for the most part, but their lack of curiosity and lack of interest stems from something, maybe from the fact that nuclear uranium is a small portion. The front end of the fuel cycle, all the stages, is 20% or so of the cost to operate a reactor. Nuclear is single digits of that. Maybe because it's a small cost, they're not interested. But whatever it was, I'd not seen that before in my entire career. And that's when I realized, that my math isn't wrong. My math is right. They don't want to hear it, and that's going to be their problem. Let's express the view. We did. The NEI, to their credit, said, "Come on back in 2019 and talk to them again." And prices had started moving up, and I was met with the same resistance and told I have no idea what I'm talking about. Prices have quadrupled since then. And I'm still told I have no idea what I'm talking about by that same cohort, which I find very comforting, because when they start to agree with me, then I'll probably change my mind about where we are.
Well, that's really interesting. And it's also interesting that they as you say, they haven't really come around, but investors certainly have. You've said that the uranium market is broken and dysfunctional, but at the same time, that means asymmetric opportunities are unbelievable. So can you run us through that?
It's really, it's in that. It's in what I was just discussing regarding the market participants, and also the market structure, in the sense of what people's attention is focused on. Investors love action, right? They love looking at a Bloomberg terminal if they have one, or their Fidelity or whatever E-Trade account they have, and they're seeing the flashing lights of where prices are going. In this market, it doesn't really work like that. There's a physical market, right? And most investors want to look at, if they're looking at gold, nickel, copper, you name it, any commodity, natural gas, oil, they're looking at stuff that's trading all day long, and it's moving, and it's going up or going down. There's futures curves that you can, or whether how accurate they are, but they are what they are. In uranium, it's a physical market that there's a spot market, which could be 15-20% of the market at any given year, sometimes less, sometimes a little bit more, but it's a much smaller portion, and it's an over-the-counter market. It's not electronically traded. There's no electronic bids and asks. You can't track it during the day. There's a few brokers that will trade it, and there's 7, 8, 9 traders that will trade it. It could take months to get a storage agreement at one of the few storage facilities in the world, and the price is reported once a day at the end of the day, and that it doesn't always mean a trade took place. It means the bids and the asks moved around, and so you've got a market that is a minor portion of the uranium market that's infrequently traded. And when you look at the participants of that, it's really 3 participants that trade in that market. It's physical traders of uranium. It's nuclear power plants that will infrequently buy a small portion. But of that, just to wrap some numbers around it, if the spot market trades 45, 46, 47 million pounds in a normal year, if you look over the last 20, 25 years, utilities might buy something along the order of 12 to 15 million pounds a year in there. So if you say demand, round up to 200 million pounds, and the spot market trades in the 40s, and utilities are 15 million of that. The utilities are a small portion of it, but of the spot market, let's say of their 15 million of the 45 million, 46, 47 million. So you're a third. Then you have producers who oversell their contract book, go in and buy some uranium. And then you have the rest are traders, and that's a smaller portion of producers. And then the rest are traders, who a trader is someone that's going to take they're mostly very short-term view of the market, typically a couple of weeks to a month. They don't really keep balance sheets. So they don't keep a lot of uranium floating around. It comes in typically through offtake agreements they have with mines. They take it in, and then they turn around and sell it, and they will sell it to whomever is there. But at the end of the day, a price is reported, so people look at that. But again, it's a very small portion of the market. Now it serves a role. Like post Fukushima, there was excess uranium in the market, and that 45 million would have grown to 100 million in the spot market. And so it's a surplus disposal market. You're getting rid of the excess. But utilities want security of supply. So most of their uranium is bought under long-term contracts that typically can range anywhere from 4, 5, 6, 7, 8, 10, 12 years, but 6, 7 years in that ballpark. And that's done under supply agreements that are long-term. And those are negotiated mostly bilaterally between producer and uranium or a nuclear power plant in a very bespoke manner. There are some requests for proposals that go out. Utilities will send them out just to see where the market is, and sometimes they buy them through that. But a lot of it occurs between mutually agreed upon prices that you're not really going to see all the time. And certainly it's reported once a month. So the very nature of the infrequency of price reporting, the opacity of price discovery and reporting, makes it an unusual market to follow, and so it's not something that most investors are comfortable with. And then that's the market structure of how price discovery occurs and how transactions occur. And then from a broken, dysfunctional portion of it is really, I would say, goes back to how the utilities buy, right? They don't buy low, and we may talk about this later, but a symptom of that would be normally security of supply is number one, and what you would see is as a result, utilities want to, or typically should, replace what they use in a given year, and you're looking for replacement rate. But if you go back and look over many decades, when prices are very low, if you go back from the early 90s to the mid 2000s, when prices were, today they're 85, they were $7, $8, $9, $10. Utilities were only replacing about 1/3 of what they consumed in a given year. They were drawing down some inventories. They would nibble in the spot market. They would do some different things. During periods of rapidly rising prices, they overcontract. And if you look at the last cycle, when the prices really started to soar into the 60s and 70s and 80s and 100, 110, 120, they were contracting at 110 to 130+% of their annual consumption. So they're not buying low and selling high. They're not buying when it's low, and they're buying when it's high. And so it's a bizarre approach to the market, but that's how the market operates. So on a daily basis, it trades around, the equities trade around, the equities trade around based on how physical is reported that day. And really, it doesn't really mean anything. It's a small, tiny portion of the market, and most of the time, there's nothing going on. Some months, there's a little bit more uranium in the market than not, and it might go down a few dollars. And people say, "Oh my gosh, something's going on." It means nothing. It's a couple of traders had a couple 100,000 pounds that they couldn't handle. They didn't want to keep on the balance sheet. It's not an indication of the structural supply demand of the market, and that's where we're focused on.
Mike, let's address what you just said in two parts here: spot market and replacement rate longer term. Spot market uranium, do you believe, having said all that investors, large and small, spend way too much time focused on the price of uranium in the spot market, and maybe over exaggerate the impact of the spot physical fund as well? Let's just take that part to start with.
Yeah, no, I think so. Yes. I mean, it's not irrelevant. Spot's not irrelevant because it's a price that is historically used. People will mark contract prices to spot pricing at some point in time. But then what you start to see is, at the end of the day, if a small portion of the pounds trade in spot and the bulk of the pounds trade in the contract market, well, it comes down to how much economically viable supply is there from the mines. And ultimately, you see that the economically viable supply, which is determined by long-term pricing and price incentives and capacities, will lead the day. And so while people will focus on the spot price day to day, again, some days you're trading, most days you're trading nothing. This month, for instance, 100,000 pounds have traded. We're halfway through the month. That's $8 million of uranium is traded in the spot market. It's meaningless. Last a month before, you could have 2 million pounds traded. Still small, but the prices will move around a little bit because bids and asks are moving around a little bit. Meanwhile, at replacement rate, you're talking 200 million pounds of uranium that will be contracted for, over a cycle, and even more because our demand numbers are higher than that. But I'm just using round numbers. So, I think, and people will stare at what's happening each day in Sprott, and then they'll sometimes reflect it in the equities, sometimes not. Sometimes they'll ignore it, sometimes they won't. But at the end of the day, and I get it, right? People have said to me, "Well, I don't care. I want it to go up right away." Well, then you're in the wrong trade, right? When moon, when rip, when go higher. I don't know what to tell you, right? Like all I can tell you is we started buying when uranium was $18, $20. It's sitting in the mid 80s now. Equities were a lot lower, and you go through periods, whereas it takes off and then it pulls back, and it takes off and it pulls back 2 steps higher, 1 step back. If you're somebody that's inclined to chase and buy them when they're going up, you might at times feel frustrated, right? You should be buying them when they're pulling back if you believe in the fundamental story, just like the fuel buyers should be buying when prices are down. They don't, right? And so what winds up happening is they pay materially higher prices, right? And same thing with the equities. If you believe in the supply demand imbalance, when short-term noise is going to pull it down, or short-term movement in spot price is going to pull it down, spot price can move back. Spot price is down this year at 18-20%. It's still up materially. It's down on the year 7%, but from its peak, it's down 20. It's had nothing to do with the fundamental supply and demand in the contract market, where contract prices are up 16% on the year. So you have spot pricing down on the year 7%, down from its high almost 20, but yet contract pricing, where value is created for companies, is up 16%. And why? Because there's not enough economically viable supply. And as the utilities start to buy more and more uranium and start to get closer to replacement rate, that's when prices, we think, even go higher from there. So it's not like you can watch natural gas or oil and say, "Oh, look at that! Here's what's going on day to day." It's different than that. It's a much more illiquid market and much more opaque, and you have to really peel the layers back to understand what's moving it.
Last question on the replacement rate, which you said up until around 05 was about a third of consumption. Now it's around 80%. And as you said, that in an upcycle, which we're in, that could go to 120, 130, 140%. Hypothetically, if your thesis continues to play out and we get to, let's say, 130%, what's the timeline and what's the probability that that's going to happen?
Sure. And actually this year, so Mark, you're right. Last year it was about 80%. This year, you're on pace to do significantly less than that. We think the reason that you're seeing is you started to see, it was 2022, you started to see contracting start to elevate. 2023, it elevated a great deal. 2024, it's come down like this. We think there's a couple of reasons. The main reason is there's a Russian uranium ban that U.S. Congress signed into law, passed, and it was signed into law. And the guidelines for the waiver process. There is a waiver process. The ban starts 27, 28. We would expect that because the U.S. gets 25% of their enriched uranium from Russia. We would expect the waivers for the first couple of years to be relatively easy to get, because it's a 2-year fuel cycle, and you just told the folks this year you can't you can't buy it after that time period. You got to give them a couple of years to do it. But there's still uncertainty around the guidelines. And then, like in anything, when there's uncertainty in the market, people pull back until there's more clarity as to what the exact waiver process will look like, what the exact guidelines are. So we would expect as the year unfolds to do that. But as we think about contracting cycles, they have been buying. I mentioned last cycle from the early 90s to 2004. You saw a third being replaced. And not too dissimilar here since 2012. 2011 was Fukushima. It is about 37%. And then you started to get, you climbed higher in 2022, 2023, you were getting closer to the 80. But the inventory, it's driven a lot by inventory levels. And inventory levels at the utilities are quite low. The producers have very low inventory levels, especially the big Western ones. You've also had geopolitical reshuffling, right? If you think about just going back a couple of years, if you think about where uranium is produced, 65-70% is produced in the East, and 65-70% is consumed in the West. So you're going through, I don't want to say battle lines, but geopolitical shifting taking place, and security of supply plays into that. So when we look out into the future, these are long-lived assets. A reactor takes 6 to 10 years to 12 years to build, depending if you're in the East or the West. The mines can take 10, 15, 20 years to discover permit, license, finance, build, and get into production. We're talking about the future, 2030 is tomorrow, 2035 is the week after tomorrow, and 2040 is 2 weeks from now, right? In mine life. So when we look out and you start to look out over the next 10, 12 years, we estimate that something like 9 out of the next 12 years isn't under contract. In a market that's shifting, in a market where there's not enough primary supply right now to meet the demand. You're talking over the next several years, you're talking a couple of billion pounds out of 3 billion pounds or around those numbers of consumption. A couple of billion pounds need to be contracted for. And when we do the math, we just say, well, there's not enough mine supply right now. You need to bring on new mines. As a matter of fact, we would argue, and it depends, there's variability here. It depends on the demand, on the enrichment tails that you use, and we won't go down that rabbit hole. But demand is not just a function of how many reactors there are. It's a function as well as that of how much enrichment capacity there is, because there's certain amounts of uranium that are needed, different amounts that are needed based on enrichment capacity. But when we look at that, the enrichment demand and the amount of availability, there's a tremendous shortfall in the amount of available supply. And so you need new mines for that. And when we do that math, we look at anywhere from 20 to 25% of the uranium that will be needed in a reactor in 2030, in all of the reactors. 20 to 25% is not a mine yet. It's not. They have not been fully permitted. They have not been. They have not gone through all of that process, the licensing process. They've not gone through the financing process, and they've not been built. And so that takes a long time in mining. It's like I said, 2030 is tomorrow. By 2028, 2026, the structural deficits are here. Our structural deficit math, starting even now, is depending on the enrichment levels. You can have anywhere from 1820 to 40 million pounds plus per annum. And so they're drawing down inventories and they're sucking down whatever's left out there, but they need new mine supply. And that mine supply doesn't yet exist in a producing mine. And if you look at mines that are going to be built, most of them don't come on time. And so that's a big bet utilities will make. So our view is they're going to have to start contracting fairly quickly to incent then another 8 to 10% of the market that is on care and maintenance that could come back online, to get Cameco to say, okay, we'll bring back the US, we'll bring back Rabbit Lake, we'll do that, but you got to pay us for it. You got to pay us a lot higher prices. You're going to have to pay us to get it restarted. Those are things that could occur, and price is the great elixir for that. And so we would expect that contracting will, once clarity comes on Russia, we would expect that you start to see more activity in the second half. And just by the sheer volume of pounds that need to be contracted, you're going to start to see it. But it's not going to be easy. It never is in this trade, in this investment. Like I've said, I've been talking to these folks for 6-7 years now, and they've told me today again. I stood up there in 18 and 19 and told them prices were going a lot higher. You did a great job. Let me explain to you my variant perception from what's out there. We're going to share with you my view and how the math and how we get there. And I was told I was an idiot by these people, by the fuel buyers. Those same fuel buyers today will still tell me I'm an idiot, and prices have gone up 4x. And it's almost like you're on candid camera. You're looking around saying you're joking, right? But no, that's their view. And whether they believe it or not, maybe they don't. Their actions have shown they've paid up, right? They paid a lot more for uranium, and they're going to have to pay a lot more. They haven't wrapped their head around that yet. And the reason for that, Mark, is if you look at the fuel cycle, it's mining U3O8. It's then converted into uranium hexafluoride UF6, and then a gas. And then it's sent off to an enrichment plant, which is where the magic happens, which is where it enables it to be turned into what can become fuel when it becomes fabricated. And you look at the market shares, Russia owns 40% of the enrichment market, 30% of the conversion market, but 15% of the uranium market. And so when you look at where the prices have gone, you've seen the price of conversion since 2016 has gone from $6 to $60. You've seen the price of SWU enrichment, separative work unit, that's the unit, has gone from in the mid 40s, $50 up to 175. And uranium's gone from 18 up to 85 or so. So you've seen the whole cycle moving. They move more towards conversion and enrichment because Russia has had a bigger market share there. And after Fukushima, there was a complacency in the market, recency bias, complacency bias, just assuming they'll get all that uranium. And again, utilities are pretty bright people, right? They're nuclear engineers buying this stuff. But if you are buying most of your stuff on a long-term contract of uranium, and you're buying 5, 6, 7, 8 years, how often are you in there discovering price? Not very often, very infrequently. You're doing other things. You're securing conversion, you're securing enrichment. And they've been lulled into believing, even though prices have gone up 375%, they will still say, yeah, we can get uranium. So they go kicking and screaming. Who cares? Ultimately, they're going to pay the price, with the exception of the Russia uranium ban this year, which slowed down contracting. We think it will pick up a pace that has been rapidly accelerating.
I'm glad you covered those spot prices and the gains from 2016, roughly. I was going to ask you about that. Okay. You covered that. I want to get to the conference you spoke at recently in the Bahamas, which you described as very exclusive, bespoke crowd, 28 to 30 people, big time asset managers, high net worth, family office, and so on.
Yeah.
After you presented, you said pretty well every person approached you and said in so many words, I want to know more about the uranium trade. I didn't know about this. Tell me more. So how does that square in terms of where we are in the cycle and why you still think that this trade is still fairly new?
Yeah, it's a great question. Being in it every day and seeing it go up or down and over time, over years, right? Years now. Sometimes I get sick even hearing myself talk about it. Sometimes you get sick of thinking about it. Sometimes you get sick of the fuel buyers. Sometimes I get sick of the companies. You ebb and flow, right? Always, but eye on the ball, supply, demand. Supply is in great shortage, and ultimately that plays out. But you start to see when I first started investing in this, there was really only a couple of analysts that were even following it anymore. If you were a uranium analyst post Fukushima in 2011, you either got fired or you went and covered base or precious metals, and maybe you covered Cameco because your investment bank wanted you to. But for the most part, it was very, very few analysts. And then over time, right? Actually, Dave Talbot, your Red Cloud analyst, was around at a different firm, but still covered uranium through the whole downturn. Now he's at Red Cloud. But for the most part, it was an abandoned sector. But over the years, when prices move like they have, more people gain interest. And also remember my thesis at the beginning. You don't not remember. I wouldn't expect you to know this. My thesis was not driven by a demand cycle. It was driven by uneconomical supply. The price of uranium was $18, $20. It cost in the 50s to pull it out of the ground. Well, that's not complicated. Once those contracts start to roll off and they're uncovered, someone in the uranium mining world is going to have to say, we can't make money. And my bet back then was, well, it would have to be half the cost curve was profit-seeking enterprises. And one of those would say, okay, no mas, we can't produce it at 50 and sell at 18 or 20 or 21 or 25 or 30. But it was actually the biggest state-owned entity. It was the biggest company in the world that did it. Kazatomprom, the state-owned entity with the lowest cost on the cost curve, they cut supply, and then the rest followed. But it wasn't predicated on demand. It was just getting back to that. Now, it's a demand and supply story. Right? The supply story is a little different. It's not about where the cost of production is. It's about, sorry, utilities, you waited too long. That horse left the barn. Good luck trying to chase it down. You're going to have to sprint. You're going to have a great rope, and it's going to be a long way down the road before you do it. And that long way down the road means higher prices. On the demand side, demand has it's done a 180. When I first started looking at this, it was the United States, which is almost 30% of nuclear power demand. That it was precipitously you were looking at a precipitous decline over the next several years. The French, who derive 75% of their electricity from nuclear, were talking about going to 50. The Japanese were offline post Fukushima. The English were reducing their dependency. The Germans had quit it. They went from 30% of their grid down to almost nothing. South Koreans, who are a major player, were talking about getting out of it. This is 2017. Now, every one of those I just mentioned have done a 180, and nuclear power is back in vogue. So it's a very different environment right now, but it plays out over time, and it doesn't. It has ebbs and flows, but I've seen the sell side come into it. I've seen so many more participants come into it, where you think, oh, okay, gosh, everyone knows the investment right now. All the big, not all, but several of the big investment banks have picked up coverage. There are more investment funds coming into it. My phone rings more often from hedge funds and mutual funds wanting to learn about it. But at the end of the day, I go to this conference in February, March, where there's 28 to 30 people, 27, 28, 30 people, really a couple of $1 trillion asset managers, a couple of enormous sovereign wealth funds, some mining entrepreneurs who everyone would recognize the names, who are wildly successful, and you name it, large family offices, and literally almost everyone said, could you tell me about it? Not really familiar with the nuclear story, the uranium story, just like to get more up to speed on it. I had one huge asset manager say, I have an army of allocators telling me all about I should be buying copper, but nobody's told me I should be buying uranium. I mean, that is so encouraging to me, because that means the story is not out there yet amongst some really smart, sophisticated investors. Some are, but there's a big room of people here that weren't on it. So it's those days where you feel like, geez, a lot of people might really know it. How long in the tooth is it? Fundamentally, it's not, but sentiment-wise, and you do something like that, you're like, wow, there's still a big cohort of people that still need to learn about this.
Now, that's very interesting. So, as you say, you started with the supply thesis. Demand did a 180, so that's another pillar to your concept. You say that the fuel buyers, they've waited too long to sign contracts. They're going to pay through the nose. So it's not a straight line, as you've mentioned. It will ebb and flow in the uranium sector, and the nuclear sector as well, obviously combined. So is there a way to sort of look at supply and demand, look out several years, and sort of figure out an end game of any sort as to what price uranium will eventually get to?
Yeah, so I only can look at history to inform maybe where it's going to go. I do with any company I'm looking at, where to trade in the past valuation wise, what levels, not price levels, but multiples. And in this, it's what did the last cycle look like, peaks and troughs, what was happening, right? So we subscribe to industry forecasts. We have old research from the sell side and that we look at and we study, and the industry forecaster, the biggest one, we're a subscriber and we read everything. I mean, I don't know, by now it's probably 20,000 hours of studying this stuff, and modeling out everything we could find. But when you look back, it's funny how narratives drive people's investment views, and oftentimes narratives are wrong. And we argue strongly, supported by math and data and the written word, that and modeling, not our numbers, but just looking at what the models were back then, when people would argue that the reason why uranium pricing went, common commentary is, the last bull market started when Cigar Lake flooded. What's Cigar Lake? Cigar Lake at the time was going to be a mine coming online in 2007 from Cameco at 18 million pounds a year in a market that time of demand, let's say 170 million ballpark. So it was a big mine coming online, and it was much anticipated. And it had a minor flood in early 2006, but then in late October 23rd of 2006, the entire mine flooded. And so that today is credited with kicking off the bull market in uranium. That's not the case. Did it flood? Yes. Did prices move a bit higher? Yeah, they did. But prices were up from $7 at the end of 2000 to the high 40s by the time Cigar Lake flooded. It had moved almost 7x by the time that mine flooded. 7x in anyone's book is a bull market. 600%. I mean, that's a raging bull market. After the flood, and now if I'm a fuel buyer, and I've said this, anyone watching this has heard me say it, they're probably sick of hearing it, but sorry, it's the facts as we know them and as we saw them. If I'm a fuel buyer and I'm looking at the industry forecast, what is it right before the flood? And I look out and I'm going to buy, let's say, a 6-year contract. What do the next 6 years look like? There was 125 million pounds surplus in the market. That's just what there was. So I'm a fuel buyer. I'm thinking about contracting. I don't know Cigar Lake's flooding. I think it's coming online next year. The forecast shows 125 million pounds. Okay, good. That's great. The mine floods. Prices move from the high 40s into the 60s over the next couple of months, but not crazy. They don't go crazy considering they came from 7. And then the new forecast comes out from the forecaster, and it shows a surplus over the next 6 years of 225 million pounds. So that 18 million pounds a year that was coming online got displaced with a little bit lower demand and new mines that they found that would come online. Yet pricing then went from the 60s, and over the next, let's call it 6, 7, 8 months, they climbed up to spot market 137. In the term market, long-term contracts, they were being signed in the 90s. So $30, $35 higher. And that's with the deficit. Now, also during that time period, there were 2 things that were happening that were serving as a great peace of mind tool for the fuel buyers. The first thing was you had about 20 million pounds a year coming into the U.S. market from a program called megatons to megawatts, where the U.S. was paying the Russians to downblend intercontinental ballistic missiles that were nuclear missiles, to downblend highly enriched uranium used for weaponry, to low enriched uranium used for nuclear power, and then we would take it in. So if you're 20 million pounds a year out of the U.S.'s 50 million pound of consumption. So if you're a nuclear fuel buyer in that time period, you don't have to keep that on your balance sheet, the whole cohort of them. It wasn't a balance sheet item. You knew it was coming in. You didn't have to worry about it. You're pretty sure you're going to get it. So great peace of mind, and it's a nice flow of things. That doesn't exist anymore. The second thing was Kazatomprom, the state-owned entity of Kazakhstan, who is the number 1 producer today in the world at 41% of production. At that time, they were not. In 2005, they were producing 9 million pounds of uranium per year, forecasted to go to 21 million pounds by 2014. Well, that 5 million pounds became ultimately 9 million pounds, ultimately became 56 million pounds by 2014. So they were newer mines, but they were bringing on a tremendous amount of supply. Kazatomprom still exists today. They're the largest, but they've kept their production very steady. They've been having production challenges. So that peace of mind isn't there. And geopolitically, it's been more challenging for them. So this cycle, if I look out 6 years, and I even look at the forecaster, that the bigger forecaster that's out there, who we think errs on the side of the utility, not errors on the side of the producers. It just happens to fall that way. We think strongly, would disagree with that, but even they show deficits over that time period. If you were to look out over that next 6 years, in the last cycle, they showed massive surpluses. And when utilities got a little nervous, it didn't matter that there were surpluses. They went out and tripped over themselves and contracted at clips of 110, 120, 130% of their annual consumption. And inventory levels are kind of similar as now. And they don't have megatons to megawatts. They don't have the Kazakhs flooding the market with uranium. Except now, even the forecaster has deficits. We argue they're much greater than that. So how does a fuel buyer react when they start really contracting for what their annual consumption is? That's where you understand how much economic supply is there, right? And there's not enough economic supply in the marketplace. It's relying on, we talked earlier about mines being built. And so the good thing about uranium and the safety valve, which is the elixir, is price, but the safety valve for utilities, if you didn't have enough physical uranium and you draw down all your inventories, and they wouldn't go to zero, you'd have enough, but as prices go higher, inventories become dear because some of the utilities are really smart and they've contracted and they have supplies and they're willing to sell it. But by and large, there are those who don't. But in the world of the nuclear fuel cycle, you have the ability at the enrichment level, and I'm not going to go down this rabbit hole, but it's a technology element that allows more uranium to be enriched, to be produced. You just have to increase the tails, and you need more of the UF6, and over time, without getting into it, you can produce more uranium. So it's not as though there's a risk of running out of fuel. We don't believe that's the case, that reactors will shut. But we think that the combination of an apathetic buyer and not enough mine supply that's economic for the producers will lead to prices that will go higher. Now, we only can look at where prices go last time when there were surpluses in the market. They went to $137 in the spot market, $95 in the contract market. For a brief period of time, they spiked to $137. It was like this, and then it went like that. That's $200 in today's dollars. And, you know, the market will determine where it goes.
Right. More than double from where we are.
If you know, again, a lot can go different than that. I can only look at the past to inform me on where the future would go. Certainly the behavior is the same as last time. They don't buy when prices are low. They buy when prices are high. I have a lot of baseline now in conversing with them and sitting down at conferences with them. And this is a cohort that I've never encountered before as a professional in trying to have regular conversations where you're on the other side. And I don't even understand why somebody would be so resistant, because if you hear us out, all we're doing is telling you should be buying it. You can be buying at better prices. That's what our message was. Right. And it was met with a resistance I've never seen before. So.
Two more questions here for you, Mike. One on M&A, one on how investors may want to play and invest in the next several years. So this is for my own edification. I'm just curious. You look at fission uranium. They make their RRR discovery in the Athabasca Basin in 2014. Everybody gets excited. The stock goes to, let's call it about $1.60 a share. Fast forward 10 years. Recently, Paladin Energy out of Australia, they want to buy fission. Fission says okay, but it's at a lower price than what it was 10 years ago. An implied value of, say, $1.30 a share. So can you just explain to me, if I'm a long-term shareholder of fission uranium, should I be disappointed with that result?
So, Mark, as a matter of form, I don't discuss individual companies, only because I don't know what people's risk tolerances are. I just don't make recommendations. I don't do that. I can tell you I had a very similar conversation with the CEO of fission uranium. So I shared my thought on that. So, yeah, I will. I'll leave it at that. I won't get into how I view it. I think you made some interesting points.
Right. Okay. Fair enough. Now, I do know you don't give stock picks specifically, but if you could give any sort of advice to, let's say, an institutional investor, high net worth, a DIY, whether they're in the sector already and have positions in a portfolio, or they want to get in, do you have any just sort of general advice in terms of how to maybe structure a portfolio in order to get exposure to this upcycle in uranium?
So I don't give advice because I'm not in the advice giving business. But I mean, First thing I would say is have a strong stomach, because the volatility is pretty much unlike anything you've seen before. There's a zealousy that you see from the bulls and the bears, right? Both sides. In terms of structuring, I just say there's, you have to understand, there's some of the things to think about in the sector are what type of geopolitical risk are you willing to take, right? You wouldn't be too surprised to think that, to realize that some of the cheaper valuations are in the more challenging geographies and geopolitical risks are higher. So, one has to understand what's their comfort level on that. Because on paper, some things look really cheap. And if you can sleep at night with that, great. If you can't, then you shouldn't be there. I think you're entering a phase where, when I first started back in 2017, 2018, exploration wasn't really needed because the demand wasn't part of the story. So production and development were more in vogue. Now arguments can be made for you need more exploration. You certainly need more uranium, economic uranium. So I would look. You could look across the exploration, the development, and the production side. Like I said, geographically, I would be aware that there were probably 50 companies when we were looking at this originally and started investing in it. Well over 100 now. I don't recognize many of the companies. They're tourists. They were stuck in one commodity that they chased, and now they're coming into another. And they're out telling a great story. They have a land package. They've got this. They got that. And they're going to do this. And we don't hear from them, right? We hear about it somewhere along the way. But I would think if you're a uranium company looking to raise capital, you probably would reach out to people who are in the uranium investing space. But they don't go to the institutions. So I just buyer beware, understand where these companies and have come from and stuff like that. And then you could look at, there's physical, right? There's the physical through the couple of different vehicles that are out there that own physical. Bigger institutions could certainly express the view by buying physical uranium. It's not easy. It's a very opaque market. You need storage accounts. They're time consuming to get, expensive to get. But you can express the view that way. There are some opportunities as this market evolves to structure. I believe there will be opportunities to structure transactions with utilities as they start to get nervous as time goes on. If you're a physical owner. So there are things to do, and then there's, like I said, there's producers, there's some big ones, some small ones. It's just, but the volatility is extraordinary, and there are moves that will take your breath away, both to the upside and downside. If you're somebody who is staring, one of the things we've seen recently is nuclear power as a data center and AI play. So you started seeing it in April and May. Everyone was talking about it. Data centers, NVIDIA going crazy, all the data centers. Amazon signed a deal with Susquehanna on the power. So now all of a sudden you see everyone saying, these big tech companies with data centers are energy hogs. They want natural gas. They need uranium. Absolutely. But those deals are not going to manifest itself in uranium pricing today, tomorrow, next week, or the week after. And what tends to happen is we can look at all the structural deficits we want, and they all make sense. Like I said earlier, people tend to react to what's going on in the here and now. Everyone's got a long-term horizon until the market opens or closes, and it trades around a little bit. Right. So sometimes you'll get these themes that come in. Will data centers play a role in nuclear power? Yes. Will nuclear power play a role in data centers? Yes. Will that mean more uranium? Yes. Will it be tomorrow or in the near term? No. So you just have to understand that. And so you see that in the last few days, one of the data centers, one of the chip companies had a bad quarter, and all of a sudden they take some of the some semiconductors out, get shot. Anything with data center exposure gets shot. The nuclear power plants that have were down 10% yesterday. Cameco was down 8 or 9. All for what? That's not a big part of this. For nuclear power plants, they're still going to do their thing. And for Cameco, it's really not an impact, but it impacts the equity. So you just got to be aware that the volatility in this stuff is pretty dramatic. Yet the physical uranium when it moves. It moves when utilities want to buy some or uranium, or a trader needs some, or needs to sell a little. So expect the unexpected.
Right. You're referring to ASML yesterday down 10% or so, the
right.
semi-equipment
Yes.
maker. And then
Right.
You're right with the term tourists. I know you're familiar with Hedgeye. They talk about macro tourists bouncing from headline to headline.
Yes.
Hence, you get these short-term moves. But
Mark, we see it in the if you were to go to some idea dinners or lunches with other funds, and you're just sitting around, and one of the investment banks might host a dinner, and these are very, very in and out, small drawdowns. They don't want risk. And if it stops going up, they're out. But they also bring a lot of capital that could take swift moves up. You just got to be kind of aware of what's going on in that.
Right. Mike, I told our viewers that they would be learning a lot in this hour or so, and we certainly have. Can't thank you enough for. We literally are the beneficiaries of years of deep work from you. So we really thank you for today's conversation.
My pleasure, Mark. I always enjoy speaking with you, and I'm happy to do it. And thank you for having me.
Okay, thanks again. We'll see you soon. Mike Alkin. Yeah, you too. Thank you again. Mike Alkin, the CIO and founder of Sachem Cove Partners. Thank you very much for doing this. Our next core conversation, I believe, is Wednesday next week with Mark Selby, CEO at Canada Nickel. Check out the Red Cloud website for more information, and follow Red Cloud on all the social media channels to keep up to date on these coming conversations with thought leaders in the mining sector. Thanks a lot for watching, and we'll talk to you next time. Take care.